Hello everyone, I'm Hemant Kanawala and I head equities at Kotak Life Insurance. I would like to share some of the key developments and our view going forward. To begin with, I hope you and your family members are safe and taking all the precautions necessary to protect you from the coronavirus. April and May was a challenging period for our country with daily new confirmed cases of 4 lakhs and active cases of 37 lakhs at peak. However, due to the efforts taken by the government and all of us, there is a good improvement in the situation. Currently, daily new confirmed cases are less than 50,000 and active cases are around 5 lakhs. But there is no room for complacency as fear of third wave is staring at us and only way to avoid it is through aggressive vaccination program. So far, India has administered 34 crore doses and additional 50 lakh doses are given daily. Large part of the country should be vaccinated by December 2021. Coming to the economy, we believe there are 4 triggers in the near term. The first is the opening up of our economy. To control spread of virus, various state governments had announced lockdown, which impacted the economy. As new cases of infection are coming down and more people are getting vaccinated, the government will have more room to allow normal activity, which should benefit the economy. The second is expectation of normal monsoon by Indian Met Department. This should help rural India, which has been severely impacted by wave 2. Third is pro-growth policy announcements by central government. Over the last few years, the government had announced various measures like reduction in tax rates, production-linked incentive schemes, and more allocation towards capital spending, which should start yielding results now. The government also announced fiscal stimulus package of 6.3 lakh crores to support the economy in the face of COVID wave 2. Finally, accommodative stance adopted by RBI and keeping interest rates low in the system should help the government in managing the fiscal deficit and support the economic growth. In the medium term, pickup in exports due to buoyant global economy and strong investment cycle should help the economy. As we know, equities are slave of earnings in the long term. Let us see how is the earnings cycle likely to play out. From FY10 to FY20, nominal GDP increased by 12% CAGR, while Nifty EPS increased by 6.5% CAGR only. Corporate profit was mainly impacted by lower commodity prices and asset quality issues in banking sector. As a result, profit to GDP ratio declined from 7% in FY08 to 1.6% in FY20. This has improved to 2.6% in FY21 and we expect this to further improve to around 4% in the medium term. This should ensure high double-digit growth in earnings for a sustained period. Consensus is estimating 30% and 15% growth in Nifty EPS from FY22 and FY23 respectively. In the past, Nifty EPS increased by 3.5% CAGR from 1997 to 2003 as the economy was subject to a lot of external shocks. This was followed by high growth period of 2003 to 2008 when Nifty EPS increased by 25% CAGR. What are the main risks to the market? First, valuations are on higher side as Nifty is trading at more than 20 times 1 year forward earnings. This is mitigated by RBI's assurance to keep interest rates low till the economy normalizes. When the interest rate increases, there can be some contraction in PE, which should get compensated by increase in earnings as we roll forward. Second, withdrawal of liquidity by US Fed, which may trigger risk-off sentiment in emerging markets. FI interest in India is high and they've invested $23 billion in CY20 and $8 billion in the current year. India has also received FDI of $65 billion in CY20. India's forex reserves are at all-time high of $608 billion. This has lent stability to Indian rupee in recent times and should prevent sudden depreciation of the currency. What should be the asset allocation strategy? We believe that interest rates have bottomed out and it may gradually inch up as the economy normalizes. On the other hand, corporate India has strong visibility of earnings growth for the next 3 years. Hence, we prefer equity over debt over medium term and will advise to increase exposure on correction. Thanks for watching the video.